Hello everyone, happy Sunday. In today's video, we're going to take a look at the overall market, what the next steps are on the SPY, the NASDAQ, the IWM. We're going to take a look at the bonds, the yields, the Fed, the balance sheet, and a few other things, all right? Earnings next week as well, and a lot of important news. All right, so without further ado, also, if you guys are enjoying the content and everything, please make sure to like the video, comment, subscribe to the channel, put on your post notifications, all right? So without further ado, let's get started with the video. All right, so number one, we have a lot of earnings for economically sensitive and financial stocks this week. So towards the end of the week, we're going to have Delta, we're going to have some banks, and then on Friday, it's a very important day. We have Wells Fargo, Citi, BlackRock going to be reporting earnings. So this week should be very, very interesting for the IWM. All right. Next, for the news upcoming this week. Wednesday through Friday is going to be very, very important. Wednesday, we have CPI data coming out, core CPI data coming out, and then 2 p.m. we have the FOMC minutes. Then Thursday morning, we have core PPI data coming out. And then Friday morning, we have retail sales. And then 10 a.m., we have consumer sentiment preliminary data. So Wednesday through Friday is going to be very important in terms of news. Monday and Tuesday, not as much, so it's going to be a bit easier to trade, but then Tuesday is most likely when things are going to get a bit more choppy, and the IV on the option contracts are going to increase heading into Tuesday to Wednesday. All right, so keep that in mind. So next, what I want to look at is Friday, because Friday the market was closed, right? But we had non-farm employment data coming out, and once again, like for the past few months, the actual number of the jobs that people thought we were going to have was much, much higher than the forecast. So on the forecast for March 10th, the forecast was 224. The actual was 311. So every single month, the actual number was much higher than the forecast. And you could also see the unemployment rate dropped from 3.6%, which was the forecast, to 3.5%. So jobs are growing. The economy and the that is growing. So basically, right before Friday when the news came out, this is so what we're looking at right now is the rate probabilities. So the chance of a rate hike for this May meeting. So the probability of having a rate hike for May was 48%. After Friday, once the Friday news came out, the probability of having a rate hike jumped up from 48% to 71.2%. So having a strong labor market is a good indication that we're going to continue having rate hikes. All right, so that is basically what this chart is literally saying. We're like this. It jumped up almost. It jumped up from 48% to 71% based off of those job report numbers. So that's very important to look at. And really quickly, the other thing that I want to take a look at was the Fed balance sheet. So we had this big spike up in March, but since towards the end of March, we've been steadily declining in terms of the balance sheet. So basically when the number is declining, right, it's not good for the stock market, and there's less money to be injected into the market. And if the balance sheet is shrinking, then obviously there isn't as much money to continue being pumped into the market. So the fact that this is happening is not the most bullish sign. So this is not very bullish. All right, so these are the dates that we had unemployment change numbers, non-farm employment change numbers coming out. All right, so I mapped these out on a chart, and essentially they coincided pretty well with tops or bottoms in the market. So you can see November, December, January, February, March, April. You can see how almost every time it's been a pretty clear reversal in the trend. So this ended up going higher after the news came out. After the news came out, we fell. Then again, we rose and fell. Then we rose. So now, if everything persists in the same pattern, right? Given the fact that Wednesday is going to be CPI data coming out, And we're also going to get FOMC minutes. We're also sitting at resistance. Things, it's going to be pretty interesting. So another thing that I want to look at is obviously we're in a head and shoulders pattern, right, on the SPY. This is not a bullish pattern. But regardless, before we look into that, like, essentially we can see that we're trading in this downtrend here, right, from back in August, and it's creating an ascending triangle based off of this news, right, and based off of the fact that in May we're going to get there's a 70% chance that we're going to get a rate hike. Is the market going to end up falling off of this level of resistance here at 412? We never even broke above 412. That entire last week, we didn't break above 412, nor did we get a retest of the upper level of this trend line here. So is all of this just a good opportunity to go short based off of the data that we have, heading into the CPI data coming out, as well as the Fed minutes? It's sure looking like that, to be honest, because but it mainly depend, especially with the Fed balance sheet also shrinking, and especially with the MACD indicators and the technical indicators also falling here, right? You can see the momentum on this indicator is dropping lower, all right? With all of that combined, and the fact that we haven't broken above level of resistance, it's not a great sign for a continued bullish move. But is this going to be the one time where we're finally going to break this pattern, where we're finally going to break above? And regardless of having this news, instead of falling lower as the pattern suggests over the past few times, are we going to break up higher? That is going to be very interesting. But the thing is that the risk reward to the short side is so much better at the moment, unfortunately, right? April is technically a bullish month, but looking at all of the data, looking at the Fed balance sheet shrinking, looking at the pattern with the unemployment change and everything like that, especially given the fact that we didn't get any sort of clean close above 412. If we get a close above 412.50, 413, sure, that's when things will be comfortably bullish. But until then, it makes more sense to lean short. And unfortunately, what I really wanted for us to happen, which would have been easy for us to be bullish, is if last week we ended up breaking above. But the fact that we're reversing here, the fact that we're showing a lack of strength, the fact that we're creating an inverted, a head and shoulders pattern on the SPY as well, it's not the greatest sign in terms of a bullish move. All right, so head and shoulders patterns are generally very, very bearish patterns, and they usually mean that they're going to fall much lower. And if just the risk reward for being short, so much better. And yeah, I mean, we did skyrocket up off of these lows here purely due to the SVB crisis, right? And we saw a big influx in the largest tech stocks, primarily caused by a rotation from all the weak stocks into tech, right? But once the smoke is cleared and things come back to normal, especially given the fact that last week we didn't close above 412, 413 on the SPY. That's one of the biggest issues here for a continued move to the upside, is unfortunately we didn't get a close above those levels of resistance. But with everything taken into consideration now, it's looking really tough to be bullish until we get closes above those levels of resistance. Because for now, it just looks it doesn't look that great, all right? So once again, in terms of the rotation, right, all of the money that was in the IWM and the banking stocks and everything like that, obviously this took a huge hit, right? So all of this money needed to go somewhere. So they were selling this and they were buying into the NASDAQ. That's why a few main large NASDAQ names, tech stocks, showed a very, very strong rally, right? And that's what usually happens towards the end of the month and early into a month. right? Because it's window dressing. They want to make their the percentage profit per month look good on 50/50 funds, as well as just funds in general, right? But now that everything, all of this stuff is happening, it's very difficult. I mean, the numbers are on our side in terms of reversals, right? For the non-farm employment, we have a strong labor market still. The labor market is indicating that the Fed is going to continue raising rates. And if the Fed raises rates, obviously that is not a bullish sign for the overall market. And the risk reward, I mean, the only way that we can snap this momentum to the downside, right? So clearly we have some downward momentum here. The only way we could snap this downward momentum is if we get a solid close above levels of resistance. And the odds of that happening is not very high, especially if that didn't happen last week. But of course, if it does, then we'll lean long, and it will be a really, really brutal short squeeze, because many people are basically short. And because just technically it doesn't really make sense to go long up here, right? It makes way more sense to be short against 412, 413. But to go long, especially at levels of resistance, is not the best. So it's going to be a very interesting week, to say the least. A lot's going to happen, and I'm excited. So I hope you guys are excited too. But yeah, things look pretty interesting. I hope you guys enjoyed today's video. Make sure to like, comment, subscribe. I'm gonna try to make it I wanted to make it shorter because it's Sunday and enjoy the weekend and everything. But yeah, take care. Make sure to like, comment, subscribe. Put on post notifications, and thank you guys for your support. Have a good one. Thank you.